Get daily investment news you can use.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is a Monday. It is also the beginning of a new month. That's right. It's the month of March, which has some interesting statistics to it. We'll talk about that in a moment. We'll get to the before the bell section. But one thing that happened over the weekend, of course, is Trump announced the crypto reserve. Now, this has got the Bitcoin enthusiasts really happy this morning, but it's going to include, in theory, and this is just something that he tweeted out over the weekend, but on Truth Social, not on X. But anyway, talked about this crypto reserve. It would contain Ether, Bitcoin, Ripple, Solana, and Cardano, supposedly, which would be in that kind of crypto reserve. Of course, that has certainly helped over the weekend, got Bitcoin kind of off of its duff a bit. It was sitting right on the 200-day moving average, so good timing of the news, held support, bounced nicely. That's going to translate into a little bit of a rally into markets this morning. Right now, futures are pointing higher. Nasdaq's up about 148 points. S&P's up about 15 points. Dow's up about 155. So it'll be a nice open to markets this morning. We'll talk a little bit about kind of what happened on Friday and then kind of going into today. But one of the other things that's going on is that we saw on Friday the Atlanta Fed GDP number. And of course, when I was doing my interview with Thoughtful Money and Adam Taggart the weekend, it was like, did you see the GDP now number? It's now showing a recession. No, it's not showing a recession. It's showing negative growth for the first quarter. But that's only because of this data point that came in from the trade deficit. Now, the trade deficit was very interesting because it told us exactly what we've been talking about here on the show over the last couple of weeks. In particular, is that we were seeing some inflationary pressures coming through some of the data like ISM prices paid. We saw it in the ISM manufacturing prices paid as well. And that was because there was this massive surge of front running for tariffs. So we had a lot of businesses running out. They were buying goods and products that they needed to get ahead of tariffs. Another thing that was really one of the largest contributors to that trade deficit number was the amount of gold that was imported from the London storage into U.S. to store here. Now, that didn't change the price of gold at all, but what it was is people importing gold to get ahead of tariffs, because if they waited till after tariffs were implemented and then imported the gold, they would have paid a tariff on that import, right? So big import of tariffs. Well, that led to a really big trade deficit because of this record surge that we had in imports. Now, most of that is over with now. So what the problem with that is that all of that front running, now everybody's kind of loaded up on inventory. That's going to have less buying here in the near future. So we're going to potentially see some weaker economic data coming. But we now have confirmation of what we suspected. We were seeing these upticks in prices, and there was concerns about inflation. It was like, no, something's going on here. It's not quite right. And now we know that it was just, we suspected that it was kind of front-running tariffs. Now we kind of have the actual evidence of that. So again, something to pay attention to there, but it's not. This is now going to have a net effect going forward of showing some weaker data. But that trade deficit, which basically led to a very sharp drop-off in the Atlanta Fed GDP now showing a negative print for the first quarter. That's not going to happen. We're going to get some more data out. We've got the employment report on Friday. That'll lift the number a bit. So we'll be back in a positive territory very shortly for the Atlanta Fed GDP now number, but it will probably be a weaker quarter. Now, there's plenty of evidence right now that we're getting an economic slowdown on several fronts. Retail sales were weak. Personal consumption expenditures were weak. We saw the trade deficit issue. That's going to weigh in on that as well, imports and exports. Don't forget that GDP is 70% consumption, and the rest of the GDP calculation is government spending, also on a decline, right? So that's, with what's going on with DOGE and everything else in the government, we're likely going to see some retracement of government spending. and particularly government hiring, that's going to impact potentially the employment data, showing some weaker economic growth there. And then also imports and net exports, right? And then business investment. So those four things make up the GDP calculation. Predominantly about 68%, just call it 70, is personal consumption. So it's what you and I are buying in the economy on a daily basis, and that's where GDP comes from. So just kind of keep that in mind. So here's what you need to know before the bell this morning. It is the month of March. March tends to be a seasonally stronger month of the year. So again, we have the seasonally strong periods of the year, which is November, December, January, February, March, April, May, right? Those are the 6 months that are the seasonally strong period of the year. Now, March tends to be one of the stronger months, March and April. Those tend to rise on average about 1% or a little bit more on average during the seasonally strong period of the year. So we just got out of the seasonally weak period of the year. Now remember, we were talking about at the beginning of February, when we did this little bit in February, we said, hey, be careful with February. February tends to be strong in the first half, weak in the last half. And right, and that's of course in the last half of February, it was not a very pleasant experience. Markets sold off pretty well going into the last half of February. Now we had a nice little rally on Friday as pension funds, they do their rebalancing in February. So we saw a good bit of buying right at the end of the market on Friday. Strong advance, market was up about 1.5% on Friday, but nice recovery rally off support on Friday. Now, that leads us into the beginning of this month. We have some benefactors right now for that, which is that we have extremely negative investor sentiment because of this 4.5% decline from peak to trough that we had. Investor sentiment was extremely negative. Professional investor sentiment got pretty negative. Also, they got their positioning off sides a little bit too much to the bearish side of the camp. But retail investors had some of the highest level of bearishness that we've seen really at any point over the last couple of years, going all the way back to 2020 in the middle of the pandemic. They weren't as bearish, they were about as bearish then as they are now. So again, just a very small decline, but retail investors got extremely bearish during this decline. Markets were oversold enough here to get a bounce, and now we kind of get into the month of March where we wrap up the quarter. We got quarter end rebalancing coming up for portfolios. So a lot of offside positioning right now, a lot of negative sentiment. That's a really good setup here for a bit of a short-term rally. Now, that doesn't mean that we're going to go racing off to new highs, but it does kind of provide a nice setup here for a counter trend rally. Again, that real negative sentiment provides the fuel because now everybody that was offsides because of this and sold into this sell-off here is like, oh, I got to get out, the market's crashing. They're not going to have to get back in. That's going to provide that negative sentiment, that negative bias, provides the fuel for the buying to come here and start pushing asset prices higher again. So again, you've got professionals offsides, you've got retail offsides. That provides a nice little setup here. And again, that all kind of coincides with the month of March anyway, which tends to be a little bit seasonally stronger. And then we get into tax season, of course, in April. People get a refund. They put that into the market, so April tends to be good. But now we're starting to approach the end of the seasonally strong period. Once we start getting into June, we'll have to start kind of thinking about what happens next, because typically during the summer months, you'll remember last year, July, August, we had about that 8.5% decline. It was the whole yen carry trade blow up. That tends to happen for some reason in summer months. They tend to be weaker. But again, for right now at least, be a little careful being too bearish here. Markets are likely going to give a bit of a rally just because we're oversold here. We've got some good negative sentiment to provide that rally. So trade that accordingly, and then we'll just help you navigate it from here. But that's what you need to know before the bell this morning. So when we come back, we'll pick up with talking a little bit about the economy as well. Lots of evidence now that the economy is starting to really kind of slow down, and we're going to see some pickup on that, and that's going to weigh on earnings. So we'll talk about that next. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP GP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So talking a little bit about this rally in the market here. So we saw a really nice rotation trade in the market over the last really kind of 2 weeks. In particular, we saw a lot of risk off in equities. We saw that rotate into treasury bonds, had a nice rally in bonds, and now we're to the inversion of that, right? So as I talked about on Friday with Adam, bonds are extremely overbought here. So if you're trading bonds, take profits. If you're trading stocks, buy stocks. So we're now in the reversion of that trade, at least for the time being here. So again, bonds are very, very overbought after their recent run. So I wouldn't be surprised to see yields kind of creep back up here a little bit, just as money kind of comes out of that safety trade to go back into risk. And so we see kind of a risk on trade here for the next couple of weeks. So again, there's a good setup here with sentiment as negative as it is right now. And tomorrow's article, when I'm here with you in the morning, I've got lots of data from this past weekend. So a lot of the sentiment data comes out like on Thursday, Friday. So I can run all the analysis on Saturday. So I've got tomorrow's article is really talking about this negative sentiment setup. So we'll talk about that with you tomorrow. But this all feeds into earnings expectations, and we're finally starting to see those analysts starting to back off of their more exuberant earnings expectations. Now, remember, I showed you this chart previously, but expectations for quarter four of 2026 are $290 a share. So it's just so far above the long-term kind of growth trend of earnings at 195. You just kind of got to say that something's going to cause a reversion in earnings estimates. And we're starting to see those come down now, not nearly enough. They were expecting 15% a year growth for 2025. They've ratcheted that back to 10, but that's still a significant downturn in those estimates, which, again, if you were buying equities based on that 15% growth rate this year, you overpaid for the asset, right? Because now you're only going to get 10% growth. 10% growth is still not bad, but that's likely going to come down a whole lot more. And that was really kind of the analysis that we've been kind of going through just recently, because the economic data isn't really nearly as strong as some of the headlines suggest. And again, we get these employment numbers, and the article, an article I'm writing for Friday, is talking about the risk of what's happening with DOGE and immigration on the economic data. Because again, when we take a look at where's all the economic growth been coming from? Yes, a lot of it's just from normal economic activity. The economy's not bad. I mean, right? Overall, the economy's doing okay, but we've had a significant ramp up in hiring over the last 4 years by government. Just a tremendous number of jobs. And that certainly has been feeding into these stronger than expected employment. We get these employment reports that are, 100,000 jobs above what was estimated by the analysts. And we're like, man, these job numbers are so strong. And the Fed's looking at these job numbers going, well, we can't, we're kind of worried about this, this employment strength. It's just, we have these really strong job reports. And that's all fine and dandy, but a lot of that was government hiring. And government jobs have substantially higher wages than the average job in America. So that certainly helped the economy. That certainly helped feed into earnings as well because we've had stronger economic growth. At the same time, we had a lot of illegal immigration over the last 4 years. And, that's been a hot topic for political, narratives, et cetera. But there's been little doubt that we've had an exorbitant amount of illegal immigration coming in. Well, where do those people go, right? Well, they get jobs in areas of the economy. They'll hire illegal workers. And, that's construction, that's restaurant, that's retail, that's, lawn services, all those type of things. Those certainly feed into those jobs reports as well and feeds into economic growth. And so there's certainly an impact from that immigration that's coming into the country. Well, now all of a sudden, we're tightening up not only hiring in Washington, right? We're actually reversing that. There's now been a tremendous surge of layoffs in Washington. We're tightening up border security, which has we've seen border crossings fall by 95% over the last couple of months. So that's certainly going to impact the flow of workers into those areas. And if we take a look at the employment data, where are the majority of jobs being created? Right? When you take a look at the breakdown of the sectors of the market, it's leisure and hospitality, it's construction, it's manufacturing, it's those types of jobs. That's where all the jobs have been created. And a lot of that has been supported by illegal immigration. So when we start reversing this data, all of a sudden there's a real risk here that we could see much weaker employment numbers, and that feeds into incomes and it feeds into spending in the economy as well to show up. Again, 70% of GDP is basically consumer spending. So if you extract people from the ability to spend, that's going to slow economic growth. And we're seeing that. This is the Chicago Fed National Activity Index. And it's trading below zero, has been doing so for a while. And the latest print was negative 30, which was a much bigger decline than what people were expecting. But it's trading well below. So the red line. So to understand the Chicago Fed National Activity Index, this is how it works. If the number is below zero, where it is right now, the economy is in contraction. If it's above zero, it's expanding. So we're in contraction mode economically, and we've been there for quite some time, right? So again, a lot of the economic data we see is like, man, this data is really strong. But then we look at all these other indicators, and they're really weak. Now, the Chicago Fed National Activity Index doesn't get a lot of headlines. People don't pay a lot of attention to it, but it's a very important indicator economically because it's 85 subcomponents. It's very broad, covers hard data, soft data, you name it. It's in that index for the most part, and it's nationwide. It's not a regional survey. It's not, like the Richmond Fed or the New York Fed is not looking at regions. This is a national index, and this has been showing rather significant spats of weakness within the economy here over the last few months in particular, and we're starting to see some signs that it's weakening further. But this all feeds into the fact that the economy is slowing down, and the economic growth rate of the economy is declining. You can bring this chart up, Brent. This is just the GDP annual 4-quarter change, and where we're sitting right now is about the economic growth average going back to 2000. We had this really strong spat of economic growth post the pandemic because of all the money that we injected in the economy, but that's all been coming out. So despite the fact that the stock market's doing well, the economy is slowing down, and the economy is where earnings come from. So the whole point of this conversation is that the markets are currently betting on really strong rates of economic growth to generate really strong rates of earnings growth. The problem is the economy is growing at about 2%, a little bit better than 2%, and we're heading towards that 2%, sub 2% level over the course of the next year. And importantly, and this is the conversation for Friday, which is that you take a look at what's going on in Washington. Again, I'm not saying that what Trump is doing in Washington is bad. It's not. It's good. We need to clean up all this kind of wasteful spending that's going on, clean out the excess in Washington. We just have too many people that don't do anything. Whenever we have a government shutdown, the first thing we do is we furlough 900,000 people, and the economy and the government still runs, right? So there's at least 900,000 people in Washington that we don't need, right? So, and that's why they're called non-essential. They're not essential to run the government. So do we really need them? So I'm not arguing the point that we shouldn't be doing these things. I'm not saying that at all. We do need to do them. We need to be transparent about where our spending is going. We need to understand where, what people are doing, those type of things. That's what, government should be run efficiently. That's no doubt about that. But the fixing of that has an impact. You don't get to fix that bloat without impacting the economy. And that's kind of the real point here, is that there's a risk. There is not, the risk of a recession later this year or first part of 2026 is not zero anymore. And I think you have to be aware of that risk. When you start talking about the reversal of immigration, you start talking about, a reduction of government spending, government employment, those have been big drivers for the economy over the last really 12, 24, 36 months. Has been a big support for earnings growth as well as economic growth. You reversal of those, you don't get out of that scot-free, so to speak. So again, I think it's just something we need to be paying very close attention to. It doesn't mean the markets are going to crash, but it does, again, this just feeds into our whole conversation we've had really ever since the beginning of this year. We're much more cautious about the markets this year than we have been previously because of these underlying factors that are going on. And I still think that as we get, it doesn't mean we're not going to have some very substantial rallies here. And again, I think we're set up here for a decent rally. We're going to want to trade that, take advantage of it, reduce risk on the rally, rebalance, kind of going through our same risk management process we talk about with you on the show here almost every day. But I think this is going to be a year where we see bigger bouts of volatility this year, just kind of like what we saw. These 4 or 5% sell-offs, up to 10% sell-offs. I don't think that's going to be a rarity this year. I think that's going to be much more commonplace than what we're used to. And again, it's just going to make it tough to navigate, but we can do it. We just got to pay attention to what we're doing and really understand what's happening. So anyway, quick break. We'll come back. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So today's earnings announcements are making me hungry. We have Cheesecake Factory, followed by Wingstop and Toast. I've got a craving for toast and wings right now, and
Toast
some cheesecake.
and wings.
Toast, wings, and cheesecake.
The Real Investment Show podcast.
What diet are you on right now?
Don't eat anything and work out like a fiend. So
Yeah, how's that working out?
It's working out great.
Oh, you
I've
sure?
lost 4 more pounds, so I'm down.
That's it?
At realinvestmentadvice.com.
I didn't have that much to lose to start with.
I don't know.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, just a little house cleaning administration work here. Next week, I am out for the week. And so it is the annual ski vacation with the wife. So, tried to get out of it, couldn't get out of it. So, I'll be out next week, be back the following week. We'll catch up on everything. So, but we'll have plenty of material for you while we're gone. So there will certainly be stuff posted on our YouTube channel as well as on all of our podcasts. So if you don't use our podcast, we have podcasts on SoundCloud, Apple, iTunes. You pick it, Spotify. You can get all of our shows there on any of your favorite streaming podcast apps on your phone. So not only do we stream live here on YouTube, but we also stream the audio content to all of your favorite podcast applications. And soon we're going to be actually adding a live stream to other areas as well. So we've got a lot of stuff in the works. So wherever your favorite kind of platform to stream video is, we'll be there. If you've got a favorite streaming app that you like to stream video to, throw it in the chat right now so we can make sure and include it in our upcoming improvements as we continue to grow this. Because again, eventually, as we continue to expand, we're going to add more channels, do more types of video as well. So again, if you watch video anywhere other than YouTube, throw it into the chat and let us know what it is, and we'll try to include that as well. And no, I don't even want to know what Larry just put into the comments. So, because that's not even his, whatever Larry says doesn't count. So
He said whoever's not on next week is non-essential.
there you go.
Thanks, Larry.
We appreciate that.
Yeah.
So we are non-essential.
Next week we will be.
Exactly. So anyway, so thank you for that, Larry. Always something. So we're just talking a little bit about, kind of, what's happening in government right now. And again, I just don't think you can overlook the importance of what those changes are going to do to the economy. Again, because there's such an important part of that feeds into all the economic data. So again, when we see, as I was saying, when you look at the employment data, big government job numbers, right? There's all this government hiring. Take a look at the immigration. We can see where a lot of the lower wage paying industries, healthcare, hospitality, restaurants, those have been your big hires. Those are your big employers. Every month when we get the employment report, we see where were the most jobs created. Leisure and hospitality, healthcare, right? And that's where this immigration can find work. And again, it's just, again, I'm not, like I said before, I'm not arguing the point that we don't need to clean this stuff up. We certainly do, but it's going to have an impact. And I don't think you can dismiss that. And again, optimism is so high this year in terms of the overall market that, we've had these 20% return years kind of right in a row. Everybody's super optimistic about this is just the way it is, right? I mean, we've had a phenomenal decade of returns, even including right in the middle of it, right? You have this 35% decline during the pandemic, which was completely reversed by the end of the year. So again, nobody really remembers that so much, right? It's like, I see all these headlines, oh, market's going to crash. We had a crash, right? 3 years ago in 2020, you had a crash. Actually, it's 4 years ago now. Man, time flies when you're having fun. But yeah, so you had this crash right in the middle of 2020. And, now you got all these bearish headlines that I was like, oh, the markets are going to crash. It's not sustainable. Well, yeah, but we just had one, right? But nobody remembers it because the markets immediately recovered from it because you had, quantitative easing, 120 billion a month, and you had zero interest rates, and you had, fiscal stimulus coming in from everywhere. So nobody remembers that. And again, you go and then you kind of look, ahead of that, 2010, 11, 12, 13, 14, 15, you were cranking out 12% a year returns. And so there's a whole generation of investors, these young Gen Zs and, millennials. You got to remember, a lot of millennials, when Barack Obama was elected in the office, that was their first election that they could vote in. They were just turning 18. A lot of these millennials were just turning 18 when Obama was elected into office. Well, here they are, 15 years later. They're now in their early 30s. And all they've seen since they've been of a working age adult is a market that goes up 12 to 15% a year. And that's their appetite, right? Their risk appetite for the markets is very elevated. And that's why you see so much of the kind of mentality of that age group focused on high risk investments. They have no problem buying 0-day options or leveraged ETFs or any type of kind of leverage bet on the market, single stock ETFs, all this new innovation of product that we've seen come to market over the last few years. They've got no problem investing in that because they've never seen a market that goes down to any degree. And except for 2022, and of course a lot of them took a hit, but then they look right past that and they're going, well, yeah, but that was the Fed, blah blah blah, and now markets are up 20% 2 years in a row. They've already forgotten that, right? That one little down hickey in 2022, that's in the rearview mirror. And they're right back to taking on all this risk because it's never really been a losing opportunity for them. And so, when us old guys are going, you need to be careful of this. Leverage tends to work out badly. You're gonna have these issues. They're like, yeah, right? You've been wrong for 15 years, and they're right. Right? valuations haven't mattered. The traditional metrics, and we've talked about this on the show before, is that fundamentals just haven't mattered to any great degree because of this whole Momo chase that we've had over the last 15 years. And that's really not changing. But again, you've got a whole generation of investors now that have never seen that. It's funny. I read these, I read articles on, from other writers, doing my research and stuff. And it's quite amazing because I'll read these articles where some guy's saying, just, buy and hold investments, and that's the only thing that matters, just, dollar cost average, the S&P. And so I'll go look up the age of the writer. And 9 times out of 10, it's some guy who's like started investing in 2011, right? 2010. Sometimes, and so they've never been through a bear market. They don't know what a bear market looks like. They don't know what it feels like. They don't know how it impacts financials. And when you talk to somebody who's been through the financial crisis or the dot-com crisis, they have a very different mentality than younger investors today. They have a much bigger concern about risk and loss of money because they've been through it. My grandmother, before she passed away, she lived about 103, but she lived through the Great Depression. And after the Depression, she never put money in a bank ever again. I mean, literally everything she had was in a safe in her house. And, but that was that mentality of that generation. Like when you go through something like the Depression, it changes the way you think about investing and savings and those type of things. And so, you hear about, it's like, well, if you put money in a jar underneath your bed, there was a whole generation of people who did just that. I mean, literally, there was a whole generation of people that were putting monies in jars underneath their mattresses or burying it in the backyard or a whole variety because they didn't trust banks. And, after the financial crisis, it changed a lot of investors. I tell you stories about people that, come into our office and it's, 2023, 2024, and they've been out of the market since 2009. And now they feel like they've got to get back in. But again, that's what a financial crisis will do to you. When you lose half your money, you go, maybe I don't need to be investing, right? And that's unfortunate because investing does build wealth. But when you get to highly speculative markets like we have today, that is another risk entirely that has yet to take hold. And again, there'll be a whole generation of investors, either millennials or Gen Zs, that will have another issue. Now, again, I don't know what's going to cause it. I don't know when it'll happen by any stretch of the imagination, but we're going to have at some point another quote unquote financial crisis type event. I'm not saying it's the housing and subprime mortgage and all that. The events that cause those types of market downturns, you never know what's going to cause it. And they're always different, right? It was the dot-com, it was financial crisis, whatever it was. It'll be different, but we're going to have that again, and we're going to reshape an entire generation of people away from the markets. They're going to say, you know what, I did that whole gambling speculation thing, and after I lost 80% of my money, 90% of my money, I'm never doing that again. It will change that dynamic. But again, what causes it, who knows? But it's very interesting to watch this younger generation of investors because they really have no comprehension of what risk is because they've never had to deal with it. All right, quick break. We'll come back. Get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year. What are you going to do with all that extra income? Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets. Saturday, March 29th, Richard Rosso and Danny Ratliff answer your question about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show. So having laid out this whole conversation about fundamentals and young investors kind of ignoring kind of long-term historical realities, I'm going to have to go very quickly here, but I wrote an article on Friday discussing Shiller's CAPE ratio. And so I've got a few charts. So Brent, you're going to have to be handy on the chart buttons this morning because we're going to have to move pretty quick here to wrap up the show. But if you take a look at long-term historical valuations, now this is just annual valuations based on trailing earnings, so 1 year valuations. And, you know, we're currently sporting a very, very high valuation level in the markets. Now, again, you know, annual valuations, annual returns, those type of things, there's an extremely low correlation between the annual change in stock prices versus the annual change in valuations. The valuations don't tell you anything in the short term, and this is the big issue. I'm going to change charts. But one thing that we tend to look at is, or again, kind of one of the proxies of, you know, kind of market valuations has long been the Shiller's CAPE ratio, which measures valuations based on 10 years of trailing earnings. And the goal for that was to smooth out the volatility in earnings that can occur from 1 year to the next. You kind of smooth that out, you get a little bit better, you know, kind of look at valuations. But the problem is in recent years is that a lot of analysts and Wall Street and media writers like, Shiller's CAPE doesn't tell you anything. We've had high valuations for a long time, and the markets just keep going up. So if you're looking at CAPE, you're really not doing yourself any good. And there is a truth to that, because the correlation between high valuations and the CAPE and markets has gotten, you know, kind of detached. Right now, what CAPE valuations tell us is what long-term returns will be. Valuations tell us that long-term returns will be lower, but the difference between valuations and stock price, that correlation has really not been very good, right? It doesn't really help you in terms of looking at the changes in earnings versus what's happening in the value of the market. And so I started playing around with the CAPE a bit, and I wound up using a 5-year average of earnings rather than 10. And what this gave me was a little bit more timely metric about valuations and the correlation to stock prices. And so, if you're driving, don't try to look at your phone. If you go home on our website, realinvestmentadvice.com, or on Substack at Lance Roberts, you can look up the Shiller CAPE 5 rate. It's called the CAPE 5 ratio. Is there a better measure? That's the name of the article from Friday. So you can get all these charts and all the attendant analysis in that article. But what the CAPE 5 does is it brings a better correlation to the overall market. So in other words, when the CAPE 5 is rising, so are asset prices. When it's falling, so is it. And that's because we shortened the time period with earnings. And it was more coincident really 1970-ish, and it's been more leading really ever since about 1980. And so it tends to turn lower ahead of the market. In other words, valuations start to decline, and then the market tends to follow, generally within 6 months to a year. So it's not, again, when you're looking at very long-term charts, you've got to understand these are longer-term time frames. This is monthly data. So you get about a 6-month lead. So if valuations start to decline on the CAPE 5, that's going to give you a pretty good indication that markets are probably at a short-term peak at least. Now, the one thing is that when we look at the CAPE 5 ratio going back to 1900, we're at a deviation from its long-term average that we've only seen 2 other times in history. That was in the dot-com crisis, and then in 2021, heading into the downturn in 2022. So valuations are extremely elevated. Previous deviations from the long-term average, align with, pretty important peaks in the financial markets historically. And so we've got this very, very kind of big deviation. And secondly, though, there's a lot of arguments in the markets like, well, post World War II, things changed in the economy. Okay, then, and that's a fair statement. There's certainly things are different since, World War II. So if we extract that out and just look at the deviation post World War II, we see the same dynamic, which is a level that is basically trading about 90% above the long-term average of 17 times earnings, right? So you've got a very, very big deviation. Again, only 2 other times in history you've been this deviated from long-term means. Now, does that mean with absolute certainty the markets are about to have a significant downturn? The answer to that is yes. The timing of that is who knows. Because again, we've been here before. And again, the last time we were this deviated was in 2021. When you had stimulus checks, you had government spending, the Infrastructure Act, the CHIPS Act. Now you don't have that, right? So there is certainly a risk between valuations and the ability for earnings to sustain valuations at these levels that we've only seen 2 other times in history. And again, those led to fairly decent mean reverting events before you worked off that deviation. Now, again, not saying this happens tomorrow. I'm not saying you should be all in cash. I'm just saying that the analysis is something that we certainly need to be paying attention to, because historically, valuations matter, and they tell us a lot. Again, what do valuations tell us at the end of the day? Valuations only tell us what future returns are going to be. Now, does that mean if I say, well, current valuations levels say 3% a year? That's what they say. That's the average. But that means 10% one year, 10% the next year, you're up, 10% the third year, the fourth year, you're down 20%, then you're up the next 3 years, 10, 15%, then you're down 10%. And you look back, I don't know what those numbers would be, but you look back over the average of that 10-year period, you go, wow, I made 3%. Lots of volatility, but that type of market works off those valuations, right? That type of volatility where you just kind of grind for a decade, like we saw between 2000 and 2015. Markets went nowhere for 15 years, just kind of grounded out, and you got valuations finally reverted. That's potentially where we are. That
is going to have to happen at some point to get valuations back in line. Again, there are a lot of differences now than what we've seen in the past. You've got computers, you've got algorithms, you've got speculation, you've got a lot of differences that we certainly need to account for. And this is, the one big challenge with using valuations for anything is the timing. Valuations are a terrible market timing tool. Now, what Cape 5 does give us, by shortening that time span in earnings, it gives us a little bit more reactive model than the traditional Cape 10 measure. So the model is a little bit more reactive to changes in earnings because it's not such a long period that you're smoothing. 5 years increases that volatility a bit, but also gives you a little bit more reactive model to the markets. And that's all that the hope of that is. But that's still telling us where current valuations are right now is that future returns are going to be low. And that's going to be a function of, and again, that doesn't have to mean a 50% decline like we saw in 2000 or like we saw in 2008. You go back and look at that chart in the 1960s and 70s, you just kind of went nowhere. It was just one kind of rally and crash right after another until you finally got to 1973, 74, and you had a big bear market. At that point, the Nifty 50 blew up. But going into that, you had repeated bear markets and recessions going into that. And that was working off those excess valuations that had occurred from the late 1940s and 50s. So again, just the important factor here is, and again, I encourage you, go to the website, realinvestmentadvice.com, or go to our Substack. If you haven't subscribed to Substack, encourage you to do that. We're posting daily market commentaries there as well, so you kind of get all in one place on Substack. It's at Lance Roberts. But, what this data is important is not telling you what to do with your money today. It doesn't mean, oh my gosh, Lance said the market's going to crash, I better go get in cash. No, that's not what that's saying at all. It is saying that we're going to have to be a lot more proactive about our portfolio management going forward. There's a real case to be made that the easy street of investing that we've had over the last 15 years may be coming to an end. Now, that could be 4 years from now. It could be 2 years from now. It could be 6 years from now. But we're probably getting to a point to where record levels of corporate profit margins every year, record levels of earnings growth, those type of things, those are going to be much harder to come by because simply the economy can't generate that. And that's going to have an implication to where money goes to in the financial markets. And, again, we've talked about before, when you have a risk correlation of 1 basically on stocks, gold, Bitcoin, everything is just kind of all tied together, that is a risk that you need to pay attention to, because those types of correlations between all assets, when all assets are all kind of tied at the hip, all going up together, all going down together, that becomes problematic for the markets because there's nowhere for anybody to hide. So when the selling does eventually start, it hits everybody all at once, and that creates more selling, so forth and so on. So again, articles on the website, realinvestmentadvice.com, also at Lance Roberts on Substack. Make sure you're getting everything we produce. It'll certainly help you manage your money better, we hope anyway. We hope you enjoy it. Be sure to like and subscribe to the channel. That helps us a lot. We appreciate it. And we'll see you back here tomorrow for the next edition of The Real Investment Show. Y'all have a great day.